my screen, I'm kind of gone to the presentation mode of the workshop. Perfect. So, yeah, first off, I always like to start off with just thanks for being here. I mean, we're a Saturday morning here. I know, a lot of you are quarantined and not working and, kind of enjoying family time. And, so I do appreciate you taking this time out of your day and, this Saturday morning and, spending some time here, with me, kind of learning about, Oshawa investment properties and kind of what I believe. And Saman is also there. You may or may not see him. I'll let him talk a little bit later, but he's on my team and works with me. So he'll probably jump in with some thoughts a little bit later on in that too. So, keep in mind with this presentation, I'm happy to send this to any of you. So if you want to take notes or screenshots or anything like that, you can, but you can also just email me and I'm happy to send this out. So kind of why I do what I do, for me, it's about a value add, right? I want to add value. I want to educate. I want to coach. I want to help people get into investment properties and make money. So the way I'm making money is being a real estate agent, right? So during the transaction, I would represent you, help you buy the property, and I'd get paid a commission. So I'd really like to be upfront about, how this relationship works. I'm not asking for equity in your property. I'm not asking for a joint venture. I'm not asking for anything other than that one-time commission. And, I look at it like I'm going to be coaching you and helping you, not only during the buy, but during the renovation and, finding tenants and then managing those tenants later on. So there's lots of aspects to this that we're going to kind of go through today. So like to be clear and upfront about, what's in this for me kind of thing. And there's no sales pitch at the end. There's no $9.99 monthly subscription. There's nothing like that. So you can relax. There's no sales pitch coming at the end here. So, for me, the buy and hold investment strategy is designed, everything I'm talking about is designed for what I call the working class family. There are lots of other investment strategies that we aren't really touching on today, as far as quick flips, lending money, rent to own, anything like that. Like, to me, this is designed for the person who is looking for a long-term investment that is a tangible asset, secured against real estate, gives you a high ROI. And we're going to touch on specifically kind of, more detailed why, but, this isn't meant for a high risk investment. This is something that I can put my name on. It's something I can stand behind. Something that, for me, is very secured and safe Yeah. Sorry, give me 1 sec here. I'm just trying to remove my mouse cursor's not really here. Okay. Anyways, we'll keep moving. So yeah, why the legal 3+2 unit property? For me, there's a number of different options, and I'm kind of breaking it down. And I've always described this, so this is new for people, but I wanted to put it in sort of a chart format for you as I kind of walk you through this. So, we're talking about a buy and hold, so a long-term hold, like minimum 5 years. To me, within buy and hold, there's options of buying, pre-construction. Yeah, so pre-construction condo, the legal 3+2 unit, and then the multifamily. And there's things in between that, obviously 3 units, single family homes I would classify under, pre-construction condo as well. But there's pros and cons to each one. And for me, you kind of have the one end, you'll see the multifamily units, and the other end of the single family or pre-construction. And then what I call is kind of the best blend is the legal 3+2 unit. So for me, we'll start kind of at the top here. You mortgage pay down, right? So you're going to get mortgage pay down in any sort of buy and hold investment strategy, pre-construction, legal two unit. And when I say legal 3+2 unit, I'm referring to, 3 bedrooms up, 2 bedrooms down. So it's 2 units. A multifamily unit. So again, you're going to get mortgage pay down. You're going to have tenants in there. Natural appreciation. So this is just appreciation that happens throughout the market or over the market. So, any of these buy and hold properties, you're hoping to get appreciation. We don't know this for sure. Some people will say we're going to get 2%, 5%, 7%. We've had 30% in some instances in the past, in 2016, but then corrected in 2017. So, typically people say about an average of 5% appreciation is what you get. you'll see that I run my numbers on 0%, but we are still hoping for appreciation. And you'll see why I call it natural appreciation as we go down the list. Now, cash flow. So this is when we start to get some differences here. Typically, what I find is pre-construction condos, single family investments do not cash flow. Okay. You're going to see there's a lot of pros to them, but they don't cash flow, where the legal 3+2 unit will, and multifamily unit will, for the most part. Even then, some of those have been trickier to find cash flowing properties with those. But the legal 3+2, you're cash flowing positive right from day one, which is nice. And in my opinion, like a necessity. So now those are kind of the three main ways you're making money, right? Mortgage pay down, appreciation, and cash flow. So you have kind of those three majors, but then there's some other, tangible, things that you want to look at. So ease of entry. What do I mean by ease of entry? How much money do you need? Do you need, $5,000, $10,000, $500,000? That's going to determine if you want to get into a unit. So, pre-construction condos, the main reason why people go to them, or single family, is their ease of entry. They need the least amount of capital to get into. You have deposit structures. You can have spread it out over 2 years where you're paying deposits. That's why I believe the major reason why people get into it is just the ease of entry for them. They ignore the other stuff, or they have, other justifications to mitigate the cash flow, and you'll see the forced appreciation down below there. I'd still say the legal 3+2 unit has ease of entry. It's maybe not as easy as a pre-construction condo, but it's certainly a lot easier than something like a multifamily, where, in order to get that cash flow, you need 30-40% down, sometimes 50% down, depending on which market and what cap rates you're looking at for the market. So the ease of entry is certainly a lot higher for multifamily. Now, tenant profile. Again, I talk a lot about this. I say, the condo or the single family, you're going to get the best tenant. You're going to get an A+ tenant in a condo or a single family home. Where a legal 3+2, I'd put them at an A-. Okay, it's not as good as the condo or single family unit. It's a little bit lower, but it's certainly better than multifamily units, right? Where you're getting, the fourplexes, the fiveplexes, the buildings. Then you're getting the people on ODSP and things like that. So, workers' comp and things like that, which, again, is there's a lot of people making good money into it, so I'm not trying to bash them. I'm just trying to show you the differences in the different spectrums. Now, liquidity. So how easy is that to sell? How desirable is it? With something like a multifamily, the only people buying, multifamily are investors, right? You're limited with that, where a legal 3+2 unit, I would argue, is more liquid than a condo because it has more options for people. It could be just a pure investor. It could be, two families that are joining together. It could be someone who wants to, move upstairs and have, a little bit of rent. So I would argue that the legal 3+2 has more liquidity and more desirability, when you're looking to sell or cash out in the future. Where condos, they're still liquid. People still buy them. You could still have investors, I guess, if it cash flows, and for now, condos are still liquid. We'll see how that market changes here. So then there's the big one. Up until this point, you're kind of like, whoa, like, if I could find a pre-construction condo, that cash flows, I would buy that. And I would agree, up until that to where we're at, right? I would say, what, if you're, comparing, if you could find one that cash flows, with similar amounts of money invested into the property, I would certainly look at a pre-construction condo. But what doesn't the condo have? It doesn't have any option for forced appreciation. Okay, so another variable here, with the condo, and some people may say that you're getting appreciation with, buying in phase one or buying early. I don't believe that. To me, that is natural appreciation. The condo developers are pricing their units based off of what's happening in the market. They're keeping an eye on the market. If the market's going up, then they are continuing to, add value and increase the purchase price as you get into later phases. And we saw it in 2017 when people were shocked when phase 3 was cheaper than phase 2, and people in phase 2 were like, well, I want some money back. And it's like, sorry, it doesn't work that way. Like, it's not a guarantee that it's going up through each phase. That's just how the market's going. And after years, of appreciation, of course they're gonna adjust their prices in different phases. Now, with the legal 3+ tuning, you can force it in a couple of ways. You can do a renovation, right, which is what we're leading to with this BRRRR strategy, which I'm going to get into. You know, you can also increase the rents with the tenants by updating the unit. You can also, you know, with the BRRRR strategy, add a completely separate unit to the unit, which greatly increases the value and forces that appreciation up and makes you money right from the start. So you're not only getting a cash flowing investment property, but you're also getting equity built into it right from day one. You know, to me, is what it separates it from why I wouldn't invest in pre-construction condos. And multifamily, the forced appreciation comes in tenant turnover and increasing the rents. So a lot of times, you know, when I mention you in multifamily, you're putting 30-40% down. A lot of that is to get it cash flow, and a lot of multifamily units have tenants paying below market rents. Tenants typically spend more time in a multifamily unit, so they you know then you know have to try to turn them over, either cash or keys, which is a 2 to 5 year process. But you know what multifamily investors like is that as soon as you turn those tenants over, you're getting more value. Your cap rate drops down, the value of the property goes up, and it gives you more options for liquidity. So yeah, it's certainly an option to look at. So that's kind of my comparison, and you know, this is kind of a new chart that I've had in here, so I'd love some feedback on it. You know, positive or negative, whatever you guys think. This is you know, again, my thoughts and my opinion, and I'm sure people can would debate this stuff. Yeah, so I touched on this. The reason why condos and single family residential are such popular investments is just how easy they are to get into. You know, but in my opinion, the major problem with it is people are gambling. You know, they're speculating on the market going up, and you know, up until now, you know, condo investors have looked like geniuses. They've looked, you know, spectacular because the market has gone up and things have gone well for them, right? So, yeah. So for me, the perfect investment option, just to kind of summarize, the 60s brick bungalow, because they're typically in quiet residential streets on large lots, separate entrances, livable basements that allow for that forced appreciation of that legal second suite. You know, and this is just kind of summarizing what I was just saying, my thoughts on, you know, why it checks all of those boxes. So then we get into, you know, BRRRR, and what is BRRRR? And you hear this is now, you know, very common. I used to call it, yeah, I used to call it buy, fix, refi, rent. Then, you know, the bigger pockets made BRRRR you know, the cool word to say. So I have to switch up my slides here. But essentially, you're doing the same thing. You're buying a property at a low purchase price. You're adding value by putting in a second apartment. You know, you're keeping the exact same square footage, right? You're not extending on. You're just using that basement space to create a legal second suite, which forces the value up of that property and allows you to refinance, right? You know, people are always shocked when they hear that, you know, banks will always lend to you up to 80% loan to value. So if your $500,000 house is now worth $600,000, you know, the banks will literally give you cash and money for that right away, 3, 4, 5 months later, not 5 years. So you know, that quick injection of liquidity and equity in the property is key. So and then the beauty is at the end, you still have a cash flowing property that you can hang on to. So, you know, you're hanging on to this cash flowing property that has just a bunch of equity into it that you've built up into it. It really is kind of the, you know, the perfect scenario in my eyes. So this is kind of high level, very high level of kind of how it works. You're looking at a $400,000 property, say it needs $100,000 of renovations, and the value of the house after that is worth $600,000. So yes, you just force the value up $100,000. And again, this is kind of like the perfect property, but we have seen these as you're going to see coming up shortly. So, you know, your original down payment would be $80,000 on the 400. Your rental money is at $100,000. So your initial capital needed is $180,000. This is where we're going to go back to that chart saying, you know, is the ease of entry, you know, is it still feasible, right? And this is where, you know, you know, I could see why people would have to bow out of this strategy if they need access to $180,000. Now, keep in mind, you don't need $180,000 cash. You need access to that money. So, you know, with home equity lines of credit, I know they just came out saying that, they won't allow you to use the down payment for that, but you can certainly use the home equity for renovations and then force the value up and then refinance and use that money to pay off your home equity line of credit. So having an exit strategy with the home equity to me is a bit different than just buying a condo or something that has no way to force that appreciation up with a HELOC, because then you're 100% leveraged, right? Where here you will be 100% leveraged for 3 to 6 months during your renovation, but then after the fact you have an exit strategy to pay it off and you'll go back down to that 80% loan to value. So with that, so our new mortgage amount so say our property is worth $600,000, right? So this is $600,000. 20% out of that is $480,000 minus your original mortgage, right? So remember that was the $400,000 house. So a lawyer's going to give you a check once you refinance for $168,000. Okay. Now remember, when we go back, I don't know if I can go back here. No, I can't. You invested $180,000, but you're going to get back $168,000. So that means you're negative $12,000. So you're leaving $12,000 into this investment property. So you're going to see that when I pull up the chart, and obviously this example has been simplified just to understand the concept before I pull up my chart here, because it gets a little bit more overwhelming. But this is the general concept of it, that you're getting money back, and it's not all of it back. That the perfect BRRRR is when you get, if you were to get 180,000 back, you would leave zero money into the property. Okay, so that's what they call the perfect BRRRR. But in this scenario, with the simpler numbers, you're getting back 168 of it, of your 180 that you put into it. So now if I look at this is my spreadsheet that I have that I use to actually analyze the property. So like I said, it gets a little bit more complicated, but you can see that, and you're looking mainly at the boxes in yellow. So if you go to the top left, you have the purchase price of 405. So this is a real life example. This is actually Simon's property that he is currently working on, that he bought in November. So this is a real life example. So he purchased it for 405, put 20% down. He's managing it himself, so his renovation costs are probably going to be lower than this. But I would, for the sake of having this, a client work on this, where you may or may not be able to GC the property yourself, I'm going to say that the renovation is going to cost $100,000. And you can see on the left there, the projections that I have, and then the actual. So for an actual property, we would go and break that $100,000 into, main floor laundry, flooring and trim, a kitchen, appliances, and kind of break down what each property needs to get a renovation budget. You'll see there's a lower level there, and then the upper level figures, and then kind of some general capital expenses with roof, windows, furnace, that kind of stuff. So this is how we're going to narrow down what our renovation budget. But you'll see at the bottom, initial capital needed of $202,000. Okay, so this includes HST, this includes closing costs, this includes your down payment. This is saying that you need access to $202,000. Again, being a little bit more specific. Then the middle box in the top center there, you have your holding costs during your rental. So, the interest rate I put up a little bit higher. So again, kind of mimicking, if you were putting this on a HELOC, or if you're renovating with a HELOC and you had interest on it, we're still going to factor that in. And also your mortgage payment down, with that as well. So you're having, say, a 6-month hold time during this renovation. And then after the bottom middle box here, your refinance or flip, this is what your property is worth after. So in this scenario, we were conservative. We wanted to say, we actually had it at 560. I think the last time I did this, I bumped it up to 580 based off what we're seeing. And I still think that number could be a little bit higher, but we're going to say that the value after this renovation is 580. Okay. Interest rates, they've been, kind of creeping back up a bit, but we're at 2.79 here. Again, that can be modified to the individual investor. And that'll give you kind of your money, your refinance here. So your money returned to you is that $140,000. So in that other example, it was 168. So this one, you're going to get 140. And then this calculation is you have 140 return to you. So you're going to be negative $74,000. So you're leaving $74,000 of your own capital into the property. So that's how, later on we're going to calculate our return on investment, is how much money we have invested in the property. I get a lot of condo investors say to me, well, Cam, my condos are cash flowing. I say, okay, well, how much money is into it? Okay, if you have, $200,000 into your, say, $600,000 condo, you have a lot of money into it. And your return on investment is actually going to be lower because you have $200,000 into it. So you have to ask yourself, where are you cash flowing at how much money into the property? And you'll see when I pull up my spreadsheet, the live version of this, if we didn't refinance, our cash flow numbers would be are through the roof, right? Because your mortgage payment would be still your old one, which would be a lot lower, right? So you really got to see, that's why I focus, and I've highlighted your money left in the property is a lot of times how we analyze, to see if it's a good deal, to say, yes, this property is a good deal. I'm going to purchase this one, right? Where if you can't pull out money, or you're leaving $200,000 into a property for 5 years, to me, I think there's better investment options out there. So then we go to the top right. This is our buy and hold expenses now. So this is, what our units are going to rent for. Our property taxes are put in there. Everything is in there. So our tenants are always going to pay our utilities. So that's why they're zeroed out. You'll see I still have a 4% maintenance there of $126 a month, a $95 3% vacancy, and a property management fee. And we're still cash flowing $335. So you're actually going to be bringing in, depending on if you manage it yourself or if you pay someone else, but you're going to be bringing in $500-600 a month. But you want to, allocate those costs for, things that happen. Maintenance is going to be needed. You're going to have things break down. Very common vacancies are going to happen. Whether it's tenant turnover or if it's things that are happening right now where you're missing payments, because of a pandemic, right? You need to start saving for vacancy right from day one, so that you have that buffer and you have that set up. And I mean, $335 is not a crazy amount of cash flow. We'll talk about that in a second with different markets when we talk about why Oshawa. But for Oshawa, that's still a positive cash flow that I'm happy with, and that's going to allow me to hang on to my property for the long run. So the 5-year return on investment there at the bottom right now, the last box. So you're going to look at your mortgage pay down, your annual appreciation. I put at 0%, because I want to know what's my return going to be with no appreciation. I'm still hoping for it. I'm still, I still think it's going to happen, but I don't want to say, for sure we're going to get 5% and I'm going to run my numbers on that. I want to know what I'm going to make with mortgage pay down and cash flow alone. And that's what you'll see there. So appreciation, we're making zero money in 5 years. That's how the spreadsheet works. And if you modify that number to 1, 2, 3%, you'll see the numbers get pretty crazy. You're going to see, I'll kind of jump to the bottom there. In this property, our average annual ROI is 19%. I'm happy with that. That's a ridiculous return, relative to an 8%, 7% stock market that is very well, a 3%, very safe, mutual fund or something like that. So, to me, 19%, I'm totally cool with 0% appreciation. So then you have your cash flow, your mortgage pay down, or really how you're making your money to give you your total profit of the 73,000. So that gives you a return over 5 years of 97,000 or 97%. This isn't compounded, so this is just simplified. If we were to compound, it would look even better for you. Financial summary there, some debt service ratios numbers, some cap rate numbers. Again, to me, those aren't things that need to be worried if you're in this investment strategy of the legal 3+2. When you're getting into, multifamily and stuff like that, you can look at debt service ratio, cap rate, things like that. Your initial capital needed, so $214,000. So that's the 202 plus your $12,000 holding cost. So that's where that 1214 comes from, or 214 comes from. And then your long-term capital invested, remember, that's just pulled over from your money left in the property. So that's how we're calculating the return, based off of what you have into the property, what you're going to make, and over that 5-year period. Yeah, just kind of going over the same options. Yeah, so we're at 11 right now. I'm going to try to speed this up a little bit. So I know we're at 11 here in that now. So, and please let me know what you guys think in the comments too, if I'm going too fast or too slow here. Again, this is my second trial run through this virtual stuff, but so when looking at why Oshawa then, okay, so to me it's like, okay, great, we have um, the legal 3+2 I'm on board with. The BRRRR strategy sounds great, Cam, but can I not do this in other cities? And the answer is yes, of course you can. You can do this in any city, really in the world, right? It's the very two are very broad general concepts that I like and I agree on. Now the Oshawa is very simply, I look at, okay, we have Oshawa relative to rural properties. So we have, called Cobourg, Peterborough, anywhere out, Kingston, Ottawa, you name it from that side. And you can go from the West End, those would be all like the Londons and the Windsors and places like that, where I would say you're going to get a higher cash flow, but you're not going to get the same appreciation. So I look at cash flow relative to appreciation, and this is where cap rates are tricky because, a higher cash flow or a higher cap rate typically means a riskier property or in a market that isn't going to appreciate as much as something with a lower cap rate. Downtown Toronto has the lowest cap rates. Why do people still want to invest there? And sometimes even negative cash flow because that's where they feel the growth is going to happen. Okay, so to me, I'm again looking for that balance. I want a bit of both. I want growth and I want cash flow. So where can I find that? I can't find it even if I look at from the other side of it. Toronto, definitely not no cash flow, but tons of growth. But Scarborough, Pickering, Ajax, none of those cash flow. So to me, when I get to Oshawa, it's the first place that cash flows with the highest growth. Okay, so the first place that cash flows, and I'm talking just kind of the east end of GTA. It used to be Ajax, it used to be Whitby, and they've gone. Oshawa even disappeared here, even at the beginning of the year. If you were out at a workshop at the beginning of January, Oshawa wasn't cash flowing anymore. This correction that we hopefully or may not be seeing, could be a great thing because if Oshawa stops cash flowing, I'm out. I'm out of here. So if I can't find cash flowing investment properties in Oshawa, I'm moving to somewhere else. Cash flow is a must for me. Positive cash flow. Okay. But I also want growth. I feel like, even though I'm pricing 0% appreciation, I feel like, I want to be as close to the lowest cap rates possible, the lowest growth areas, the highest growth areas, which is downtown Toronto, which is the GTA. So in a nutshell, that's kind of, what I'm thinking. Yeah. And again, this is kind of just summarizing. I'm kind of going off here, but and then yeah, like people want to hear, so to me that's why I invest in Oshawa, pure and simple. But I also want to know what else is Oshawa doing, right? What other forms of jobs and stuff are here? What's the rental market like, right? Can I get my property rented? It is really a silly question because the rental market is so strong, really all over Ontario. To me, the rental market is not an issue, and people, always, that's always their biggest fear is, can I get my unit rented? You can get it rented. Vacancy rates are so low right now. So a lot of this stuff about what's happening with Oshawa as far as OPG and the Ministry of Finance and Ontario Tech University, Durham College, Lakeridge Health. The fact that we commute to Toronto still from Oshawa, where the last GO train stop, here are great to know. But the rental market is still very strong. So to me, it's one of my least concerns about it. And a lot of people focus on that, but again, it's about finding the deals and the properties, not necessarily the tenants. So going on to my map of Oshawa here, this is kind of the map that I always hand out. So A areas are going to be higher purchase price, higher ARV. C areas are going to be lower purchase prices, lower ARV. Okay. Same with B areas. Some people really only want to invest in areas. To me, I would invest in C areas as well. It just means that I'm adjusting my purchase price to make sure that it's low enough that because I know my ARV is going to be lower. Okay. And again, I could send this map, but these are just my thoughts. I created this myself. So these are things that I've made and, kind of where I think how Oshawa looks. Again, there's lots of little streets, like O'Neill's kind of a strange area too, because it's got Simcoe running down, and each area of Vanier has a couple, um, not so nice areas as well. Um, yeah, so it's not as simple as this makes it sound. Like if you're in this area, you're great. You're not. So that's where when we're out on the road, you kind of get a feel for it and kind of see some of the areas. So um, okay, I'm gonna skip. So I'm gonna kind of, we're at 11 right now. I'd like to kind of keep my timetable here. I know I appreciate your guys' time. So my next slides, these are all handouts that I have, that I give out. So the must-haves when creating a legal 2 unit, the zoning, the square footage, and we're going to touch on a lot of this as I look through the properties as well. What you need to create a legal 2 unit, the other factors when considering buying a duplex. So I kind of look at separate meters and laundry spaces and parking and different things. And a lot of those, like, really that's where the value, you get a lot of value when you're out looking at the properties as well. So again, I can send anyone these handouts. I have them in PDF. It's just throw them into an email and send them to you. Or obviously, if you've been to a workshop, you have these. The landlord tenant stuff, very basic stuff. I'm hoping with the Q&A and after the last half hour, we get some discussion. I know I've been, there's a lot of issues with the landlord tenant board, as we know, and especially right now since they're closed and not having any evictions. So I did a video on that yesterday and had some pretty heated comments on my Instagram page, which was interesting. But I'm hoping we get some dialogue in that second half hour there, and then with these forms. So I'm skipping through these just to keep on my time. If we have questions with them, please let me know. So